Kia ora koutou and welcome to Markets, Mystics and Mayhem, a weekly podcast with Kiwibank's economics team alongside the occasional special guest. We'll delve into the data, decipher policy decisions, monitor the markets and analyse the issues impacting the Kiwi economy. Let's get into it. All right, welcome back. Now, last week, you probably saw I had quite a smirk on my face when I said we're bringing out the crystal ball because lo and behold, the crystal ball is here quite literally because, you know, this show is called Markets, Mystics and Mayhem. We're the mystics. I almost think I'm like destined to be a mystic. You know, I'm Sabrina. When I was younger, I was like Sabrina the Teenage Witch. Now I've got a crystal ball in front of me. We get to forecast into the future. But, you know, we've got a great team of mystics. And, you know, we need a great team of mystics to really uncover what's going to happen in 2026. That is the question for this episode. Is it going to be better than this year? Spoiler alert, yes. We can't just leave you hanging on that. You need the answer now. It is a better year. But I guess, you know, to look into the future, we have to look at where we've come from. So I guess let's start with a 2025 recap. How was 2025, guys?
Not good.
No.
Frustrating. Let's just go through the synonyms of that one.
Yeah, that's what we heard a lot of people saying over the year. It just didn't eventuate. You know, we just didn't get that recovery that everyone thought that we would get. There's signs of it very late in the year, like now, but for most of the year it's been pretty disappointing.
Yeah, at the start of the year it looked quite promising. We had a pretty good summer, but it just really seemed, that momentum really seemed to have died in the middle of the year, and we recorded that big contraction and it was quite broad-based. The only sectors that did do quite well were those that were external facing, which is quite impressive given the year that we've had of really, you know, Trump and the tariffs and really changing the rules of the global playground. So, but anything domestic was really hit quite hard.
There was that interesting chart where, you know, we obviously had the Liberation Day tariffs and people started panicking and economists started revising down their forecast. But looking at this chart now, boom, you know, the forecasts were revised down on expectations of much worse trade volumes thanks to these tariffs. And reality is, they've been revised actually higher than where they were. So yeah, trade's stronger.
It's that taco. Part of that. It's the Trump always chickens out, right? So part of the reason why we're probably seeing a bit of a recovery now and why things haven't gone down that real dark downside scenario that we had probably mid-year, you know, earlier in June, is because, you know, we have seen a lot of easing off these high Liberation Day tariff rates and we've seen some de-escalation there. But there is still, you know, tariffs in the air. They're still floating around. I think, you know, we've seen tariffs on Liberation Day. They went up to, I think, 24% was the average effective rate. Even with all the de-escalation we've had now, I think we're at around 14, 15%. Yeah. And that's still the highest since 1936, I think. So well over, close to 100 years.
Yeah. But the point there is that when you ask treasuries to do analysis of tariffs, they sort of come back and go, well, a 10 to 15% tariff is kind of about right. It's just like putting on a GST. You know, there's a little bit of front loading and mucking around, but basically people just pay the 10 to 15% and move on. But anything above sort of 30, 40, 50%, you don't actually generate a lot of revenue from that tariff because people will divert away. So the fact that we've kind of come down to those sort of 15% levels just shows you that it is a revenue grab first, and then all the other bits and pieces were sort of geopolitical posturing.
Yeah. And it means that, you know, the global growth outlook is a little bit stronger. Obviously not as strong as it would have been if we didn't have these tariffs to begin with, but it helps us a bit more there.
Yeah, absolutely. I mean, we're a small, open economy at the edge of the earth, as we keep saying, heavily influenced by global trade volumes and what's happening there. But you talk to our exporters, they're happy. A lot of them are getting paid really well, whether it's dairy, meat, or other goods, wine. They'll tell you that the United States is their best market, their most profitable market. So there's obviously wriggle room in there. Currency's come off a little bit. So, yeah, our exporters, like you say, are doing reasonably well. And the service side, the tourism looks like it's picking up into year end.
Yeah, it looks quite strong. But it's the domestic businesses that are doing it tough. And that's more a reflection of the domestic policy settings just not being at levels conducive for growth, right?
Yeah, because it took so long to get interest rates into that stimulatory territory, which we are in now. And now we're seeing those signs of life emerging. But I think, your tariff shocks were one thing. The other part that, really weighed on Kiwi growth was just the delay in getting interest rates where they needed to be, right?
Absolutely.
But we're there now.
We are, we're there. Took a long time. I mean, we were calling for a 2.5% cash rate for a long time. Finally got there, in October? We haven't been there for long. But it seems to be, like you say, at levels that are actually getting people excited again. From a mortgage perspective, going from the 7s to the 5s was kind of more of a relief. But going from the 5s into the 4s, I think, is stimulating people.
Yeah. So we're starting to see signs of this pickup in activity into this kind of second half of the year. And so our outlook for 2026 is that it should be this year of growth, getting back to more normal levels of growth, maybe even going above trend, so growing a little bit more than our potential output, which is good. And it's a function of policy being much looser than what we thought it was at the beginning of the year.
Yeah. So, I mean, Sabrina, you took charge of our outlook note, particularly when it comes to media. So what were your key messages for the outlook?
Well, that it's a much brighter year ahead, that interest rate settings are at levels that matter and that are already making a difference. I think we're seeing the start of the recovery, but that continues into next year. Our growth is, as MJ said, is potentially, above trend. We've got growth, I think, averaging out 2.4% next year and then 3.1% potentially in 2027, provided everything goes right and we don't get any of these shocks. That's great. And we've got, outside of interest rate settings being at their right levels, we've got kind of everything on the kitchen bench is what we were saying. You've got consumer sentiment and consumption rising, investment intentions are a lot firmer, that's actually translating into a bit more action. And importantly, like the labour market is stabilising too, and inflation holds steady. So, check. All the conditions, touch wood, should be right.
Yeah, exactly. So growing at 2.5 and then into the 3s into 2027, why are we not worried about inflation?
Well, we still have, after these 2 years of terrible recession, we still have this really negative output gap.
Yeah.
Which, translating into more layman's terms, there's so much weakness in the economy. It's going to take a while for that spare capacity to really get fully absorbed. It's going to limit firms' ability to actually lift their prices too much still. That demand has to recover. Yes, we're seeing a little bit of recovery now, but there's a long way to go to really fill that output gap and get it back into positive, I guess. So we're not worried about inflation. We've been looking very closely at inflation, though. We always do. And we can see that the general trend of inflation is what's actually driven the lift higher in this year, because we have seen a bit of a reacceleration, has been most recently your sort of your volatile and sort of seasonal movements. But if we look at that underlying measure of core inflation, which really tells you where the trend of inflation is going, that still continues to cool. So there's not too many, signs flashing red on the inflation front. All those really interest rate sensitive components of the consumer price basket, they're really weak.
Yeah. And all of that's showing up in the labour market, right? So if that's stabilising, what's our call for unemployment? And I think even more importantly, hours worked.
Yeah, well, it looks like we're reaching kind of that turning point, at least for the labour market, where things hopefully aren't going to get worse from here. 5.3 is hopefully the peak in the unemployment rate, and from there it'll be a gradual fall back to around 4% in a couple of years' time, and that's just following the recovery in the economy. It often is lagging the broader economic cycle, so it will take some time for that employment growth to pick up. Maybe second half of the year we'll see some firmer employment growth coming through there. But just the fact that it's stable is a good sign. It helps with job security, and that helps with household consumption, knowing that they're not necessarily going to lose their jobs anymore. We'll see a bit more in that, and for the housing market as well, it's pretty important for them. So yeah, we're expecting that hopefully 5.3 is that peak, and it's just that gradual fall back to where it should be.
And we need to see hours worked as well, right? That's where a lot of the slack's showing up, right? So the number of hours that we're working are down.
Yeah.
We need to see that because you'll increase the hours of your existing workforce before you hire more people, and the underutilization rate at 12.9 is pretty high. So I'd like to see that in the single digits, ASAP, and that takes businesses, doing more and hiring people for longer.
Yeah. Because what are you hearing when you're talking to recruitment agencies? Are they seeing, because they're the first to see a real turnaround in the labour market, right?
Yeah, patchy. I gave a presentation to Tribe recruitment last week, and there were some really good questions in the crowd, a lot of interest. But you could just see that we're not back to the level of activity that's sparking a lot of employment yet. But they're hoping that things pick up next year, as we all are.
See, that's what we're looking at, right? Employment intentions, investment intentions.
Yes.
Those are your sources of growth.
Yep.
And when we start to see that really picking up into next year, which we are hoping to see, then you're a bit more confident, I guess, in terms of the outlook.
Yeah. The higher frequency ones are back in positive territory, are they not? But it's the NZIER one that's still negative.
Yeah.
Yeah, if you're looking at the other bank's data.
Yeah, no, we're not doing that. We'll wait for the NZIER. So, where to next?
Housing.
Housing.
Got to talk about housing.
I guess we have to, right?
Yeah.
Do we have to? No.
Yeah. Well, it's the only asset we own. We don't own anything else. Housing important, right? There's a lot of supply there that needs to be soaked up, whether it's just people trying to sell or people trying to rent. There seems to be a lot on the market at the moment, so it'll take a bit of time to soak all that up. But yeah, I mean we're calling for house prices to rise next year just on the back of interest rates being at levels that will entice investors back in because they've been missing for 3 years.
Yeah, we've got 2 to 3% penciled in, which, obviously doesn't really sound like it's shooting out the lights. It's not really, but it's a lot better than the past 2.5 years of tracking sideways.
This is house prices.
This is house prices. Yeah. But as you say, interest rates still remain the largest driver for the housing market, and we know they're at the appropriate settings now. And you mentioned investors coming back. I think you pulled out some pretty good stats on what was happening in the investor space, right?
Oh yeah, around who's active in the housing market.
Yeah.
Well, previously we've been saying that most of the lending had been going out towards first home buyers, which is great to see them in the market. But then we've seen that turn around and I think more of the lending is now going out to investors. It could be the fact there's this hunt for yield going on with interest rates so along the deposit side. So there's that hunt for yield and they're stepping back in. Also the fact that policy on the the tax policy side are a bit more favorable than they were at the start of the year. So we're seeing a bit more of them kind of stepping in and more lending going out to them.
Yeah, because didn't you think the stat we found that was in the last 6 months, 10% more lending has gone to investors and first home buyers, whereas this time last year there was 4% or 3 or 4% more lending going to first home buyers. So that switch is kind of starting to happen now, and it's probably because interest rates are finally at these enticing levels.
Yeah, and I think, I hate to say it, but it's the more active, more seasoned, more experienced investors that are, I think, dipping their toe back in now, because when you speak to many investors at the same time, most of them are like, no, we're worried about a capital gains tax, we're worried about this, we're worried about that. But then you'll speak to a few afterwards and they'll come up to you and say, yeah, I'm having a look, I'm doing this, I'm doing the next thing. So I think we are seeing a few of them coming back, but we need to see that continue next year because they are an important part of the housing market. And I think they'll be nervous. Some of them will be nervous all the way into the election next year.
Yeah, that's true.
I'm kind of seeing a bit of a cloud appearing in the crystal ball.
Oh my God, it's dark.
Let me just try to look at it. Okay. There seems to be a little bit of cloudiness, maybe a bit of confusion and fear. Retail interest rates have started to lift, even though the Reserve Bank only cut the OCR 3 weeks ago. What is going on there, and how does that impact our outlook?
Yeah, wow. Geez, that is pretty concerning. So what happened was, we covered it on the day. The Reserve Bank came out not as dovish as we had hoped, and their OCR track was not as low as we had hoped, and it was kind of pointing to the fact that the Reserve Bank thinks they're done, which was a very premature, whatever the word is, statement as far as I'm concerned, because
I just got
we're
it.
not
Sorry.
at that point.
I just got the joke. Continue.
And we've seen a massive move in wholesale rates, a massive move in the market. And it's the reason why we call this podcast Markets, Mystics and Mayhem, because when you get moves like that, it really shocks everyone involved. And to be cutting the OCR and then see retail rates rising is kind of only our central bank can cut and hike at the same time. Most others are a bit more sensible. So here we are. Wholesale rates have moved higher because we've gone from pricing and rate cuts to rate hikes, and the market's got well ahead of itself. The market does not do well in pricing in unchanged policy. They go from cuts to hikes to cuts to hikes, and we've got hikes priced in by the middle of next year, which is way ahead. So that move higher in wholesale rates means that when we go to the market and price our retail rates, the fact that those wholesale rates have moved the way they have has put upward pressure on all our rates, term deposits and mortgage rates.
That's quite annoying, isn't it? But I guess the sort of good news is that even with this slight tightening in financial conditions, where interest rates are still way lower than they were this time last year.
That's true.
And they're still at those really supportive levels that can still drive this recovery as we're seeing right now.
Yeah, it's more of frustration around the move. I would have, if we were doing the monetary policy statement, we would have put the track at 210, 215, just kept that bias in there. Wholesale rates wouldn't have moved. Retail rates would be even lower for longer, and you would have it at quite an obviously stimulatory level into next year until you know better. But doing it the way they did and having all those rates just kind of gap higher, it's just weird that you'd be cutting the OCR only for all these rates to lift. It just wasn't needed.
Yeah. I think maybe we would have seen some increases in wholesale interest rates because the data flow has been quite good and has been quite promising for that turnaround. But you wouldn't have seen such a big move as we have right across the curve, right? And it's just because you're looking at good data. If you're a trader, you're looking at the good data with the expectation that the Reserve Bank's on hold, so you're just going to keep pushing those rates higher. But if they kind of left that door open a little bit more, because of which would be well justified given the risks that we have offshore, any data that comes in, they'll just kind of absorb it and accept it, and just a small sell-off, not as much as what we've seen.
Yeah, you're right. There's some good news hidden beneath the surface of that move. It's just the extent of the move that's really shocked us, and the fact that there are very serious punts being made on rate hikes in the first half of next year, like months away. And we've got this massive output gap that you just outlined and no threat of inflation. It's way too soon. So I think we'll see market traders having to reverse into the new year, and we'll see those rates coming back down. But geez, what a move.
Yeah, and we might even have to see the Reserve Bank, when they come back in February, really put a foot down and say we're not hiking in 2026, right? If if they need to sort of stop this acceleration and lift and wholesale rates going higher, right, they'll need to come out. And the seasonality works in their favour because they were hawkish in November and they can just come back and be dovish in February like they always are. So it might see them come back in a dovish lean again.
Yeah, it's just ridiculous, isn't it? But yeah, we've got this hot, cold central bank, which we hope changes under new leadership next year. But yeah, I think the risk, if anything, is not that they hike in the first half of it's that they cut. So, and you know, the most likely outcome being that they're just on hold for quite an extended period to let all this work through. So markets don't like or can't seem to figure out on hold very well. So we'll see, you know, bouncing around. We've gone way too high. We'll drop back next year, and retail rates will hopefully go sideways, not up.
Because it's just too early, right? It's just, we're just talking about I'm not going to say the G word. I'm going to say
signs of life.
Signs of life.
Yeah, there we go.
I'm going to say, what is it? Awakening of a recovery.
Oh, that's a good one. I like that.
But we're only just seeing these signs now, and higher interest rates just will kill them, really. And we just need to see that momentum build into next year. So, yeah.
Yeah, absolutely.
So while we're talking about interest rates, and given that we are putting out an FX tactical, by the time you're watching this episode, it might even already be out, but we haven't actually published it as recording. But we're talking about interest rates. Where does that put the currency now? Because we've definitely found some support. We've definitely found the bottom, and we're kind of trending upwards. Going into next year, and with the recovery gathering pace, we'd expect the Kiwi to go higher. But what about the sort of complication of the markets as well in terms of the interest rates? Does that just pare back for a bit?
Yeah, I think so. If we've got too much priced in our interest rates and they come back down a little bit, particularly relative to, say, Australia or the US, depending on what cross you're looking at, we could see them come back a little bit. But geez, if we're right, and we're optimistic, and we are optimistic, the Kiwi's higher next year. You know, if it's a better world, we get those better trade volumes than what was thought. Our exporters continue to do well, and that, you know, that optimism, that activity spreads throughout the economy. You know, the Kiwi could be at 63 by the end of next year. Yeah. And hopefully that's the case, because then we've called it both down and up.
Well, if you're looking into the crystal ball and it's right, you know.
Well, I mean, I can see 63 very clearly in there.
Should we just
it's even underlined.
63.
Yeah, that's right.
Do we want to talk about migration, even though now it's kind of like coming back into it?
Yeah, you know what? The whole labour market and the migration, I think, tells our story really well. Yeah. So the migration of Kiwis to Australia
should turn
What's
around.
happening? Should turn around, yeah.
Yeah, it should turn around. We're still recording a pretty decent outflow of New Zealanders to mostly going to Australia.
Yeah.
And it's just you're comparing the labour markets, and one's just obviously stronger than the other. But as things turn around here, as our economic fortunes, sticking with the crystal ball theme, do change and do switch, then we should see that labour market improve and draw people back, or at least not, kind of stop people from leaving. Because if we look across the ditch, the RBA have very different monetary policy right now. They've had to keep interest rates quite restrictive because inflation there is quite a problem. But we're moving into a cyclical rebound, which should see a better outcome for our labour market. So that should turn around, and we should see population grow a little bit stronger next year, maybe toward the second half, with migration kind of bouncing back. But it's really going back to, I think we have it going back to around 20,000 by the end of the year, annual figures, net migration. And it's just that slow grind back to more normal levels.
Because it really is a tug of war between us and Australia, right? And we've been losing for a few years now. So for us to regain a bit of footing and sort of pull back a little bit would be quite good. And that sort of stronger population growth feeds through to the whole economy plus the housing market.
Yeah.
Yeah.
Because for housing, you've got to balance, good interest rate levels against supply, as you're saying, but also the fact that population growth has been weak. But as that turns around, again, it's a positive outlook for the housing market as well.
Yeah, and that's important.
Something about looking at this crystal ball is giving me a bit of deja vu, though, because I do think we sat here last year and had a very similar story.
Yes.
We were expecting the recovery, and we weren't alone in that. Everyone was expecting a 2025 recovery, and we have ended up in the situation where we thought it just didn't pan out how we thought. And we've kind of acknowledged that this time the settings are a bit more right, but how confident are we really feeling, and what's actually different this time?
Well, I think we need to acknowledge that the ball was quite clouded last year, and it's still clouded now. And I guess the 25 just turns into 26, really. So a lot of what we were forecasting for this year, we're forecasting for next year, because that monetary policy bit is falling into place now, not sort of six months to a year ago when it should have fallen into place. So we've got the policy settings about right, which we didn't have earlier in the year. It's just taking longer to feed through. So I think, we do need to own it. The unemployment rate forecast was bang on.
Oh, yeah, that one was
100%.
good. Nailed
You
it.
smashed that. House price forecast, way too optimistic. Economy, too optimistic. And inflation actually a little stronger than what we thought. So if we are to wake up this time next year and this damn thing works.
Where did you buy from?
Yeah. Came from Temu. Like,
Oh, no.
I don't even know what country we're looking
Oh,
at.
no.
I've completely forgotten what I was going to say. No. What was I talking about?
If we're here this time next year and the thing hasn't
okay. I'll do that bit again. Snip, cut. So if we're here this time next year and this damn thing works, I would love to look back and go, well, growth was in line or a little stronger. Inflation was benign because of the output gap, so there was no worry there. Labour markets tightened, all those good things, and would just be in a much better place.
At least we got the direction right. We did get it.
Absolutely.
Second half of the year was meant to be the year that was meant to be the time when things pick up. It's just the magnitude is where we
A lot softer.
kind of fell short of. And it was mostly because when we were coming up with a forecast for this year, we were expecting to be at 2.5. Much sooner than we were, but that's passed. Let's look to 2026.
And we're looking forward. So, quick recap then for 2026. These are your points. Maybe they can judge us on this, in 6 months' time next year.
Yeah, good idea.
Kiwi growth higher, say 2.5%, 3% by 2027. Inflation, not a problem.
Yeah, 2% or
2%
below.
2% or below. The labour market, so the unemployment rate, the current 5.3 peak should mark the peak, and we should start to see ourselves peeling away from that sort of in the second half of next year or towards 2026.
Yeah. When do you have it breaking below 5? Is it end of next year?
End of next year.
Very end of
4.9,
next year.
Like 4.9, like right on the cusp.
Yeah, nice. That's good. I can see that.
Migration, hopefully back to our sort of long-term average, 20K. And house prices, 2 to 3%. That's the recap.
Yeah.
Not bad.
Put it all up.
Not bad. Although, the fun thing is we get to revisit this in June. So
Yeah. You don't have to wait a whole year.
you don't have to wait all year.
That's right. We can update, postpone again.
Hopefully not. That's really just for it.
Well, in that case, I think that wraps us up for this episode and for 2025.
Oh,
Yeah.
wow.
This is our
Yep.
last
Last
episode. Jarrod, some special words for our viewers.
Please come back next year. Come back next year with a better mindset. We're going to be up. We're going to be upbeat.
Yep.
We're going to be optimistic again, and it's going to work this time.
Yep.
So
You've got the crystal
get a
ball.
good break, and then come back fired up. I reckon.
Yep.
MJ, couple of words.
The same. Ditto.
Well, thank you so much for tuning in all throughout this year. We know there's been some frustrating moments along the way. But yeah, we're really excited about next year. We're really excited that, every year we seem to be busier and on the road more, and it's really because we get to interact with you guys, the audience, our clients, listeners, readers, and we love the interactions we get to have with you. And this podcast has been one of the ways that we have been able to bridge more interaction. We get insights from you guys as well. And that'll help us shape our view. It literally goes direct into the crystal ball or your comments, and it processes them and then it spits it out to us. So thank you so much. As always, be sure to like, follow and subscribe, and we'll see you next year.
You've been tuned into This is Kiwi Economics, Markets, Mystics and Mayhem. We'll be back next week for more analysis and insights.
Any views or information shared in this podcast, while given in good faith, aren't necessarily the views of Kiwibank.